big move coming in. But, let's continue our focus on the markets and get you a conversation going as well. We have George Thomas joining us from Quantum AMC to discuss where the markets could be headed and individual pockets that maybe still make sense right now. George, thanks a lot for joining us. It's always a pleasure having you on the show. We've been talking about this relentless move on the markets ever since the state election results did come through. Do you think the pitch is clear now? We're going to head to higher levels. And do you think that this move will be led largely by what we're seeing in the large cap names?
Yeah, thanks, Pavithra, for having me in the show. Obviously, the sentiments have turned positive with the recent state election results. But when we look at from a valuation standpoint, the overall markets are trading slightly above their long-term average. But when we look at on the ground level how the earnings are panning out, the earnings are on an improving trajectory and in line with what we have been saying for the last many quarters, that earnings, the cyclical earnings uptick is only strengthening from here on. And that is evident even in the results season which has happened recently. And moreover, the peak inflation is behind us. So a lot of sectors which had to take rapid price hikes in the last few quarters, they would kind of see moderate price hikes from here on, and demand is very much likely to pick up. So within segments, of course, the large cap bucket seems favorable from a risk reward perspective. At least, the large caps have seen some cycle of selling from the FIIs few months back, and therefore valuations are not very expensive from a historic perspective, which is not the case with other market cap categories. And therefore, our sense is, large caps could lead the rally from here on.
George, good morning. Thank you so much for joining in. You spoke about the fact that the large caps may be the trigger to lead the rally from here on. But what about the broader markets? Because so many people have advised caution. They have been advising caution for the last 2 months, 3 months, saying that, oh, there is a lot of froth in this space. We must try taking money off the table. But the broader markets have just continued to move from one high to another. Are you advising your clients to start booking profits now, considering the rally that you have seen? Or do you see some more upside to this space? May not be as much as the large caps, but do you see some more upside in the first place?
The upside still exists primarily because, the earnings growth have been fairly reasonable. From a PE multiple perspective or a valuation multiple perspective, there is very little room for improvement in most of the sectors, barring a few sectors like banks or technology, where we have not seen a reasonable rally in the current year. There is scope for better returns, but otherwise, upside has moderated across sectors. But the underlying point is, the underlying economy is fairly strong, and that earnings cycle is still favorable. In this kind of an environment, it's very unlikely that we could see a material correction in the markets. But of course, there are pockets, even as we come down the market cap, there are pockets which have run up very sharply and where valuations are at euphoric levels. So investors should be cautious in those names. But otherwise, from a broader market perspective, it doesn't appear like a market which is poised for a material correction.
Okay, got that. So, like Hormaz was asking you, George, what are the pockets that you would book profits in right now? There are spaces like defense, like power, like railways, which have had an insane run, right? Are these pockets that you would say, take your profits and get out now?
Yeah. So when you look at some of these names, there is better revenue visibility in some of these names. But the broader point is the execution cycles are fairly long for many of these sectors, and many of them are fairly working capital intensive. So if you analyze from a fundamental view, or if you discount the potential free cash flows which are likely to accrue in the coming years, the current stock prices looks expensive in most of the pockets which you mentioned.
What about autos, George? The auto index has done very well this year as well. And most of the leading performers on the index are two-wheelers. A leading brokerage has downgraded most of these two-wheeler companies today. What is your view on this sector? Do you prefer the two-wheeler companies compared to the four-wheelers, considering their exposure to the rural market, or do you have a view opposite to that?
Yeah, we are constructive on the two-wheeler space, primarily because last many years, because of the heightened input cost pressures, the cost inflation or the price hikes have been very rapid. Some of them have seen 50-60% kind of price hikes in a short span of few years. And going forward, that the price hikes required would be very minimal. So that is one factor. So people who have been sitting on the fence, they are likely to turn buyers, and we could see reasonably strong volume growth from here on. Our sense is, two-wheeler space still has some more steam left.
Okay, some more steam left in the two-wheelers. Do you also, think, have those similar thoughts about the real estate space? The index as a whole has rallied around 70% this year. But, the sense I'm getting speaking to a lot of fund managers is that there is a lot more to go here. This is a sector that typically moves in very long cycles as well, right? So do you think that this is still a good level to be getting into the real estate names for fresh investments?
Yeah, in terms of real estate names, the number of opportunities where you have fairly large, fairly decent forecast horizon visibility, along with a reasonable valuation comfort, they have turned few. I agree with the point that the cycle is quite favorable, and we might see a longer cycle this time. But most of the stocks are priced to perfection in this domain.
What about some of these new listings, George? Most of these companies have come out with exorbitant valuations. Have you put money to work in some of these new listings this year? Because most of these companies, not like to name them, but a lot of them are up 70-80% from their issue price. What are your thoughts on that space?
Yeah, obviously, we have stayed away from all those IPOs. And obviously, the valuations, the listing valuations itself were reasonably high. And on top of that, we have had reasonably strong returns. So some caution is warranted in most of those names.
Okay, got that. We're going to leave it at that. George, thanks a lot for taking the time and speaking to us about these individual pockets of the market. We do need to get into a short break. But on the other side, we're going to shift focus from equities and talk all about the world of commodities.